Alright, what is good, my traders? Welcome back to the channel. It's your boy Daniel. This is day 3, episode 3 of the Indices BootCamp. If you've made it this long, congratulations. You beat out the majority of people that could not make it past the first episode. But hopefully you've been following along so far. Hopefully you gained some value from episode 1 and episode 2. And yeah, let's continue to build off of what we learned in the last episode and continue to kind of stack these foundational blocks to really build the system. Now, today's episode, we're covering a lot of very important topics, a lot of very crucial things that go into the trading system and go into being an actual good trader. And the first one that we're actually going to start off with is DXY, the dollar. Now, this chart right here, for those of you who don't know, this chart right here is DXY. You can see that right here, DXY. This is the dollar index, and this measures the dollar's strength and weakness. Now, arguably, dependent on who you ask, this is the most important chart in trading. Doesn't matter what you're trading, whether it's the majors or the minors or the indices or commodities or gold or silver, you always want to have an idea of what the dollar is doing because it can massively affect your trade, especially if you're trading any major pairs that have USD in them, or you're trading gold or silver, which is USD reliant, or the indices, which are also USD reliant. It's going to massively affect your trade of what the dollar is doing. And furthermore, dollar economic news, any sort of high impact red news, is going to massively affect your trade, and that's why we don't trade it. But so specifically for the indices, a very easy rule of thumb is if the dollar is strong, the indices are usually weak. So if you have a bullish dollar, the dollar's going up, usually have a bearish indice or bearish US 30, a bearish Nasdaq, etc. German 30, typically speaking, is the exception to the rule, and that is because German 30 is based off of German stocks. German 30, for those of you who don't know, is a combination of Germany's top 30 companies. That's it. That's a combination of those, which means that the USD or the dollar doesn't really affect their price too much because it's not really too relevant. However, in general, it does have some sort of impact on how the rest of the market is doing. So you do always want to keep that in mind. Furthermore, and I know we're jumping ahead a little bit and we're going to have an entire session on this, but German 30 very closely matches US 30's price action. The 230s, yeah, make that 60. But yeah, anyways, the 230s usually have very, very similar price action. So if you have a bearish US 30, 9 times out of 10, you're going to have a bearish German 30 as well. NASDAQ and US 30, they sometimes decouple and they sometimes have opposite movements, in which case it is what it is. But German 30, US 30, usually very, very common pricing. But yeah, going back to what I was saying, the dollar, if you've got a strong dollar, you've usually got a weak indice. And if you've got a weak dollar, you usually got strong indices. So that's your first little confluence that you start to throw in there with your trading. You always come on to the dollar, start on the daily time frame, and you're looking at two things. You're looking at the market structure and you're looking at the market sentiment. Now, these two concepts can be the same thing, but they can also be different. And realistically, if you're trading high probability trade setups, if you're looking for high quality trades, you are only trying to trade the days that have the same market structure and the same market sentiment. Now, what do these two words mean and what is market structure and market sentiment? Now, market structure, for those of you who don't know, just refer to uptrends, downtrends, consolidation. So just to make this very comprehensive again, for those of you who don't know, you have two types of markets, or three types of markets furthermore. You have an uptrending market, and this is when price is making higher highs and higher lows continuously, looking like this. You have a sideways market or a consolidation, or as we learned in episode 1 or day 1 of the bootcamp, this is also known as an exhaustion or a corrective movement. So you have a consolidation right here. And then you got a downtrending market. And this is when price is making lower lows and lower highs consistently, looking like this. So we've got an uptrend, we've got a sideways movement or a correction, and we've got a downtrend. Now, when it comes to the dollar, again, the first thing you're doing is you're looking at the market structure. What kind of trend are we in? Are we in an uptrend? Are we in a downtrend? Are we in a consolidated market? You can see that right here, if we come to current price action, again, just ignore my drawings, I'll just delete them temporarily. But what kind of market do you think we're in? Pause this video for a minute and let me know. What kind of market do you think we're in? Well, I'm willing to bet that a bunch of you guys said downtrend. You're like, yo, the dollar's making lower lows and lower highs like this, so on and so forth, etc. And you're not entirely wrong, but you are wrong at the same time. This is a mistake that a lot of people make, and that is zooming too far out. On the daily time frame, you're way too zoomed out. You need to understand that majority of us, a large majority of us, are not swing traders. We're not holding our trades for days on end. We're not holding them for weeks. We're not long-term trading like that. We're very much in and out of the market. We're intraday, maybe even scalping at certain points, in and out of the market. Now, what that means is that this whole context of price action is not relevant to you because that's too big of a data sample size. Again, if you look at this price action, if I get my measuring tool out, this is almost 3 months worth of price, 3 months worth of data. You are not trading on a 3-month time frame for that to make sense for you. Therefore, when I refer to higher time frame market structure, I'm only really referring to the past 2 weeks of price action. So the past 14 days, give or take. So you're actually really looking at this section right here. Now, with that being said, when it comes to market structure and higher time frame market structure, that doesn't mean I disregard the information to the left. It doesn't mean that I just completely disregard the fact that we're coming up to structure and we may retest and continue down. Again, I'm keeping that in my mind. I'm keeping that common sense because I can see that there may or may not be a level right here that we're approaching. But I'm also keeping in my mind that currently, the current momentum, the past week, the past 2 weeks has been bullish and prices made a higher high, a higher low, and a higher high. So more than likely, if we're going to continue the trend or continue the previous momentum that we've had, we're going to continue higher. So that's your basic market structure. Again, just remember to zoom in. Just 14 days. That's all you need. The past 2 weeks of price action. Now, again, do not completely disregard information to the left. If you can see a major level, you can see a major point of structure, whatever it is, keep that in mind, keep that in your analysis because it is important. But typically speaking, you don't want to be too zoomed out because it's just going to mess you up and you're not trading those higher time frames for that to make sense. Now, this market structure thing that I'm teaching you right now, this applies to everything, not just the dollar. This applies to any chart you're reading. If you want a higher time frame bias, this is how I personally would do it, especially on the indices. If anything, you want to be even more zoomed in because the indices, again, is very recent price action. If you're looking at a key level from 2 months ago, it's no longer relevant. You're looking at the very recent, most current little bit of behavior, and that's what you're working with. That's the data that you're reacting to, and you're trying to trade based off of. Cool. So far, so easy. So that's the market structure. The next thing you're looking at, your second confluence in your chain of events, is the market sentiment. Now, what is market sentiment? This is something you're gonna hear me to refer to often in it. And really and truly, I do have like two definitions of market sentiment, but I'm gonna give you the easiest one for now. Market sentiment refers to the current behavior. What is happening now? What's happening today? Because we can be in a trending market, but we can be exhibiting different behavior. For example, if I take you up here, this is an uptrending market, and we can be in an uptrend, but we can be in the process of forming a downtrend or forming a low movement. Because even in an uptrend, even in a bullish market, what do we still have? Well, we still have these little periods of correction. We still have these little periods where the price action is going down. Now, on a larger time frame, on the daily time frame, these little correction periods, this little bit down here, this may be 2 days, maybe 3 days of price action, where price is moving counter trend and it's not moving in your direction. Now, for me and my strategy and what I'm trying to teach you guys is you don't want to be taking trades on the counter trend days. It doesn't matter how high probability it is, it doesn't matter how clear you can see the setup, it's simply not worth it. On a long enough time scale, you're going to get stopped out more times than you hit TP, in my opinion. Again, some people trade reversal trades. It makes sense for them. It works for them. Congratulations, blessings to you, mate, whatever. But my system and what I'm teaching you to trade, we're trading in one direction and one direction only. And that direction is determined by the higher time frame structure and the higher time frame sentiment. They're not always going to be in line with each other every day. You're not always going to come onto the market and find good structure and find good sentiment. Majority of the time, I would say actually more often than not, you're going to come onto the market, find terrible structure and weird sentiment, and the dollar's going to be moving sideways, and you're going to be like, mate, what is this? And then that's how you know this is the day that I do not trade. Again, I don't know if I said this on episode 1, episode 2, or whatever it is, but I'm going to repeat it again. It's not trading every day. That's not the goal. That's not how you're going to get funded. I promise you. I promise you. Trading every day is not going to get you funded. Trading 5 times a day, five positions a week is not going to get you funded. What is going to get you funded is looking for one high quality position a week. One high quality position a week. Again, we're trading 1 to 2s. Bear in mind. Do the maths. Very easy maths. Most funded accounts. What's the profit target for phase 1? Most funded accounts. Profit target for phase 1 is 8%. What do we trade? We trade 1 to 2s. That means you're risking 1% to make 2%. Now, let's say you are a disciplined trader who follows the system and you're sitting there and you're patiently waiting and you only take one trade in the trading week. So the 5 days in the trading week, Monday to Friday, you sit there and you patiently wait and you take one trade that week and you make one successful move. You've made 2%. Now, if you can do that every week, which again, I'm not saying over a long enough time scale, you're going to make 2% every week, but just hear me out. If you can just make one trade once a week For 4 weeks, you've passed your funded. That's it. That's all that's required of you. 4 trades, 1 to 2s, once a week. That's it. And you've gotten funded. And then after that, you can relax even further and lower your amount of trades. But you see what I'm saying? It really doesn't have to be taking a position every day in it. Like I said in maybe episode 1 or episode 2, the only people that really take a position every day are the unsuccessful traders that don't have money. 9 times out of 10, when you take hella trades, do you know what your equity curve does? It does this. You go up, you go up, you go down, you go up, you go down, you go up, you go down, you go up, you down. And then at the end of the month, you're like here somewhere anyway. So if you just ended on like your second trade when you were here anyway, you have ended the month at the same amount. You see what I'm saying, innit? So really, quality over quantity, you're not always going to find high probability trading conditions every day. Now let's get back into it. So market sentiment, current behavior of the market. What is price action doing right now? What's it doing today? Now right here, we're currently bearish. We're currently on the way down. So when I actually talk about market sentiment, the actual characteristic and what you're actually doing is you're looking at the past 3 candles. Again, on a daily time frame, zoom in, look at the past 3 candles. Now, what are you doing with these 3 candles? Well, number one, you're looking at context. So what is the overall context? What is the structure? And what is it that you should be seeing? So obviously in an uptrend, price is making higher highs and higher lows, you would probably be expecting price to be bullish, have some sort of wick rejection to the downside and be moving up. If you come across that section of price section and price is currently printing an indecision and the previous day was a little bit of an indecision and wick rejection, again, using the context of that movement, you probably know or you have a good idea that it's no longer as bullish as it was and the sentiment or the behavior is slowly starting to shift. Now, what do I actually mean by this? Because I keep saying this word sentiment. I haven't really explained it, but it comes back to lesson 2 or lesson 1, with the first technical lesson that we've done. And again, it's looking at the size of the body relative to the size of the wick. That's the sentiment. That's the strength, the percentage strength. Again, going back, if you haven't seen what I'm talking about, take an L, mate, because you should have watched that last video, but go back and rewatch it, looking at the strength of the candle. And again, each candle, especially on a daily time frame, tells you a story about price. It tells you what price tried to do on that day. The large wick started so hard on that. The large wick rejections really mean something. They're really influential. They're really important. And again, simply by looking at 3 candles, you can get a very good understanding of what price has tried to do the past 3 days. For example, let's look at this little section of price section right here on the dollar. What has the dollar done? Well, again, going back to step number 1, what's the first step? It's market structure. Well, market structure right here, I would say we're bullish. Now, again, not taking in all of this context here to the left, just looking at the past 2 weeks of price action. What has price been doing the past 2 weeks? Well, we've made higher highs and higher lows. So that's the first step in the checklist. Bullish market structure. Second step, market sentiment. Again, market sentiment, looking at the current 3 days. Now, what can I see has happened over the past 3 days? What has price recently done? Well, we've had a bullish day, which makes sense because we're in an uptrend. So prices come up, and we've done that right here on Thursday. We then printed an indecision candle. So price had a large wick rejection either side, which shows the uncertainty. And we printed a very small volume candle. Notice how we pretty much printed a doji. Price is closing where it opened. Again, that indicates uncertainty. It indicates like lack of volume, whatever you think it indicates. But it's not a bullish candle. That's the whole idea. So we've gone from bullish to uncertain to indecisive. And now what's happened right here on Monday? Well, we've had a bit of a bearish day. Prices opened up, had a wick rejection to the upside, and has moved down. So right here, I can pretty confidently say that the current sentiment is now bearish. We're currently shifting bearish. So right here, this is a day that I would not trade. Even though the market structure is technically bullish, I know that more than likely we're in for a retracement before we even think about having some sort of continuation higher. So again, you simply would not trade. You wouldn't even begin to zoom down and go to a lower time frame to look for anything else, because you know that on a higher time frame, it is not high probability enough for you to trade. Now, does this mean that you cannot find a trade if you zoom in? Absolutely not. There's always going to be a trade. You can always zoom in to a 5-minute, 15-minute, and hourly. You can always find some sort of trade position. But again, this comes back to what I was saying. It is quality over quantity. It's finding the higher probability positions, and it's about being disciplined with yourself. It's about really sitting there and being accountable and being like, yo, listen, am I only trading right now because I want to trade? Am I only trading right now because I feel like I could maybe do something here and this could be a position and I want to make money and I want to progress? And are you trading for those reasons? Or are you trading because this is a great high probability trading setup that meets all of my requirements and it's one of my 4 positions a month? You see what I'm saying in it? Again, a mentality shift I want you guys to have is if I told you, listen, mate, you've only got 4 positions you can place a month. You have 4 bullets. I'm going to give you a gun or give you a bow or whatever. I'm going to give you 4 arrows. You only have 4 shots you can take. How much more conservative and how much more patient are you going to be with those 4 shots? You're not going to spam them all in your first week. You're not going to sit there just letting it off on Monday, Tuesday. Maybe you're going to wait a little bit later in the week. Maybe you're going to start to be more patient in your approach. And maybe you're going to stop taking these silly trades that are half probability, that are half set up. You see what I'm saying? So again, quality over quantity. I really want to re-emphasize that. So on a day like this, definitely a day that I would not trade. And what I'd be waiting for price to do is have a sentiment shift back in my direction. So on the next bullish day, that makes sense. So right here, again, that's not a great day. This is still rejection candles. Look at that. We had a retracement. Right here would be maybe the first day that you'd look at potentially executing a position or coming back into the market. On a day like this, you have bullish market structure and market sentiment. Again, is not ideal because you can clearly see that we've had a large number of wick rejections. The prices had a retest. But I would say the current behavior, at least for this next day, which would be the Monday candle that opens up, we're more than likely going to have at least a retest of these next highs. So this would be a day you'd potentially look for a trade. Again, even this example right here, I want to point out, it's not an ideal day to be trading because you'd be trading back into this like little consolidation period. So give me 1 second, I'll find you a better example. So right here, for example, this would be a great day for you to trade because once again, starting from a higher time frame, daily market structure is what? Well, daily market structure is bullish. And the daily market sentiment, again, looking at the past 3 candles, what has price done? Well, we previously broke the structural high here to the left. We previously came up and we had some bullish structure. We then consolidated here for a little while. Again, looking at the previous 3 candles, you had a little bit of an indecision candle, low volume, another low volume candle retesting the same little area. And then we had a strong bullish candle that's closed above the bodies. So this to me appears to be the breakout candle. It appears to be the candle that's cleared the highs and now we're back in that little momentum period. So now this would be a good day for you to zoom in and look for your lower time frame trade because you've got daily market structure that is bullish and daily market sentiment that is bullish. And again, the reason this is so important for you to do this at the beginning and the reason this is the foundation of the system is because this is what gives you the highest probability edge in it. Because chances are, if you find a day that has the same market structure and the same market sentiment, and you've done it correctly, 9 times out of 10, 9.9 times out of 10, price is going to go in that direction. 9.9 times out of 10 in it. That's because the indices carry their momentum. This is what I'm saying. This is why we trade the indices. They like to carry their momentum. They like to move in that direction. So what this means for you and your trading, that means if you have half a brain and you have a little bit of a skill set and you put in some work and you manage to catch a half decent entry with your stop loss in the correct position, you have a very high probability of price going into profit before it comes back on you. That's it. And you know what that equals? That equals making a little bit of money. And eventually you get a little bit better with your entry, a little bit better with your stop placement, and you start hitting take profits before price comes back. And you know what that's called? That's called profitability. And again, that's what we're here for. So it's just about having that higher time frame backing and only trading on those days in it, because you just have a much better probability of price going in your direction. Now, essentially, what I'm talking about is the trend is your friend. Innit? Again, I know a lot of people know about this, and it's like basic trading shit in it, but it really is so important because it just gives you that much better chance of hitting your target, and that's what we're all here for, in it. In comparison to when you try to trade the corrective moves, when you try to trade retracements, when you try to trade like counter trend, for example, not only do you have to be right about the direction you're trading in, but you have to be super accurate with your entry. You have to be super accurate with your target. You have to have everything on point, enter at the right time, exit at the right time, not get stopped out in the meanwhile, so you don't get faked out. You see what I'm saying? You have to be very accurate, and it just is that much harder for you to actually trade and make money in comparison to trading with the momentum, trading with a higher time frame bias. You literally only need an entry, and you just need to not get stopped out. That's it. And then price will go into profit, and you can deal with it once it's in profit. That's it. And that's the beauty of also trading with the trend, is you're going to have the occasional position where you manage to catch a beautiful entry, and it just rallies, and you end up extending your target. Maybe you trail your stop loss behind it, and you end up going from like a 1 to 2 to 1 to 5 to 1 to 10, etc., without having to have even like a ridiculous stop loss like these ICT guys. You just trade it normally, and because you're trading with momentum, you happen to catch the trend. It lasts for a couple of days on the indices. You make a lot of money, and this applies to small accounts, applies to personals, applies to the funded. You can pass a singular funded off of a 1% trade, trading 1 to 2, just because price looks good, and you end up carrying it through. And believe me, I've done that before because that's the indices in it. So anyways, let's get back into it. Now, what we're briefly going to cover before I wrap up this session, because I've spent a lot of time teaching trading today to various mentees. Shout out to the mentees in the description and whatnot. If you want that, hit man on IG. But anyways, besides the point, what we're going to be going through now is a little bit of key levels. Now, there's a couple of different ways you can draw your key levels. This is just one of my methods that I'm going to be teaching you in this episode. Maybe on episode 4 or day 4 of the bootcamp, we'll go through some more ways of drawing your key levels. But it's the easiest way you can draw your key levels. Now, again, in a trending market, you have what? You have structural highs, structural lows. Pretty simple. Structural high, structural low. Now, from a price action perspective, each point of structure, so each one of these little blue dots, every high and every low, is a point of interest. It is a key level. So that's why whenever you're in a trending market, and notice how I say trending market, not just any market, a strong trending market like this one, your point of interest or your key level is always going to be previous high, previous low. So your first point of interest, the first key level is always the previous high. So in a trending market like this, price has just recently broken above the high. So your first key level is always right back up here at the previous structural high, right here. See that? Boom, boom, continues the trend. Very easy, very simple. Now, obviously, price is not always going to respect that level. Otherwise, it would be a little bit too easy, wouldn't it? Sometimes you're going to have price come down and do what? It's going to break that structural level. It's going to break that high. Now, where do you move your level in this event? Well, you simply just move it a little bit down to the structural low. Now, notice how this structural low, conveniently lines up with this structural high. Welcome to the world of price action. And again, this is in the basis or on the basis that you're trading a clean trending market, because not every section of price action is going to look like this. As I'm sure that you guys know, it's all well and good sitting there drawing lines, but when you actually look at price and you look at the candles, it doesn't always look like this, because this is clean trending price. So a lot of the time, what you're going to get, well, you're going to get price action that looks something a little bit more similar to this shit right here, where it's still kind of forming the same thing, but it's not really. And again, this is still an uptrend, the same way this is an uptrend. But this I would consider sloppy price action. I can consider it a corrective movement. And this I would consider this clean price action and probably more of an impulsive movement. So again, it just comes back down to really picking your battles and picking your moments in the market. Is this clean price action? Is this a nice opportunity for me to trade? Can I see my level clearly? Can I see what price action is doing clearly? Now, an easy rule of thumb is whenever you're indecisive, whenever you're even slightly unsure, don't trade. Very easy. If you're unsure, don't trade. Nothing has ever positively come out of being uncertain in trading. I promise you, the only thing that leads to is bad psychology. It leads you to getting more emotional once you're actually in the trade, because you didn't even know what to do before you were in the trade. And just generally speaking, it's going to confuse you. So only trade when you're very certain about the movements. But again, previous high, that's your first level. In the event that the previous high gets broken, you move it down to your second level, and that's the previous low. Now, in the event this second level gets broken and your previous low begins to break, then chances are what's happening, well, you probably got a bit of a change of character and you may be looking for price to continue in the other direction. Now, we are going to spend an entire session about this in it, so don't think that I've just blitzed it right here at the end of this lesson. We are going to go back through this on the next one and kind of build off of this idea. But that's just the easiest, most simplified way I can give it to you. When it comes to key levels, previous high, previous low, breaks the previous low, maybe you're looking at a bit of a change in trend. And again, all these concepts work vice versa. So in a downtrend, you're looking at what? You're looking at the previous low first. If the previous low gets broken, you then take it up to the previous high. Very simple, very clean, very easy. Price action 101. Now, where do these levels actually get drawn from? Where do you actually draw these key levels from? Again, like I said, we are going to spend an entire session probably tomorrow going through key levels and whatnot. But when it comes to drawing your key levels, the easiest way to do it, and this is how I personally do it, is I usually draw my levels on the 1 hour. Sometimes on the daily. Again, it's dependent, because obviously certain times on the daily, you may come across a little bit of a zone like this, where it's just super obvious to you that something's happening here. But usually it's a little bit easier to draw on the daily, on the hourly. So I usually draw on the hourly, and the way that I draw my key levels is I try to have them relatively thin, because you don't want a huge zone. If you have a zone like this, it's not useful to anyone, because once you're on a 5-minute time frame, that becomes the entire screen and you don't really know what you're entering off of. So you try to keep them relatively small, and what I do is I line it up with the bodies. So the bodies are the important part of price action right here. So you're not really looking at the wicks. The wicks are relevant to you because the wicks are going to be bodies on different time frames. But you're just trying to line it up with the accumulation of bodies. So you see how there's two bodies right here that kind of close at the same level. I'm just going to put my key zone right there so it lines up. Now it doesn't quite line up right here, but that's all right because once again, market is never perfect. But if I go on like a different time frame, for example, and maybe show you an even better example, another key level. Again, we'll come here a little bit to the left. I'll try to show you a trending market just for argument's sake. Previous structure, all right. There's a lot of it. Can't even speak. There's a lot of examples that I skipped already. I don't know why I haven't stopped, but I'll just show you this one right here. So right here, you can see price is making structural highs, structural lows, higher high right here to the left. That would be your previous level, and you draw it across like this. Again, this one didn't quite get a retest, didn't quite get a retracement because we're on a much higher time frame. This is not what I trade. You'd be doing this on a 5 minute, and usually on a 5 minute, you do tend to get these sort of retracements. Again, I would zoom in and show you guys on a 5 minute, but if I do that, we're going to start getting into other concepts, and then this video is just going to be extended, and we're going to miss out some content for part 4, day 4. So I'm going to leave the recap on the trading key levels and all of that shit for tomorrow's session and tomorrow's day. And we'll run it because I already uploaded a video on YouTube today anyway. So furthermore, if you guys didn't watch that, go and watch it because it was a good video. I got an editor for that video. So let me know what you think about the graphics and all of that. But yeah, anyways, thank you guys for being here for day 3. I do apologize about speaking very quickly and whatnot, but literally before recording this meeting, I had like 4 mentorship sessions where I was teaching people. And then before that, I was trading myself. And then before that, I was making other videos. And I've just been talking a lot. So it's one of those where, yeah, apologies, it is what it is. But at least you got the value. And I'll see you guys tomorrow back on the channel. Furthermore, tomorrow, there's a sick video dropping. Maybe it might not drop tomorrow, but I'm filming it tomorrow where I'm going into Brighton Central, going into town. I've got this little wheel right here. I don't know if you guys can see that, but this wheel says like NASDAQ, US 30, German 30, etc. on it. And it's got a little mystery prize. And I'm going to get people to spin it. And whatever they land on, I'm going to let them trade my 10K funded account. So I have an Alpha Capital Group account that's 10K. And I'm just going to go into public tomorrow, let people spin the wheel, let them land on whatever it is they land on, and then let them trade that account. Any money that they make, I'm going to give it to them in cash, and it's going to be like a sick video, like a little giveaway kind of thing. I don't know who said it, but someone called me the Mr. Beast of trading in the comment. But yeah, anyways, I'm going to stop waffling. Thank you guys for being here. Like, comment, share it, all of that, and I'll see you guys day 4 of the bootcamp.